The 1031 exchange. The tax strategy real estate investors love. What if I told you that you could sell a rental property for $500,000 in profit and pay absolutely $0 in capital gains taxes? Legally? That's exactly what a 1031 exchange does. And real estate investors are quietly building massive wealth using this strategy while most Americans have no idea it exists. I'm breaking down the 1031 exchange today, how it actually works, and whether you should be using it. Stick around. Let me set the scene. You bought a rental property in Atlanta 5 years ago for $300,000. Today, it's worth $500,000. You've got $200,000 in pure profit sitting there. Normally, you'd owe roughly 20% in federal long-term capital gains tax. Maybe more depending on your state. That's $40,000 going straight to the IRS. Just gone. But with a 1031 exchange, you can sell that Atlanta property. And instead of paying taxes on that gain, you reinvest all the proceeds into another qualifying investment property. The entire $500,000 gets deployed into a new deal. No taxes. Not delayed. Completely deferred. Here's what makes this powerful. You're not avoiding taxes forever. You're deferring them. But if you keep doing this, if you keep exchanging properties throughout your life, you might never pay those taxes at all. Part 1. How the 1031 exchange actually works. The mechanics are straightforward, but there are rules. Strict rules. First, the property you're selling must be held for business or investment purposes. So owner-occupied homes don't qualify. Rental properties do. Commercial buildings do. Raw land held for investment does. Second, the property you're buying must be of equal or greater value. This is critical. If you sell for $500,000, you need to reinvest at least $500,000 into the replacement property. If you pocket any cash, you owe taxes on that amount. Third, and this is where most people mess up, timing is everything. When you sell your property, you have 45 days to identify your replacement property. 45 days. Not 50. Not 75. 45. Then you have 180 days from the sale to actually close on the replacement property. That's your full window. Miss these deadlines, and the IRS treats it as a regular sale. You owe all the taxes plus penalties. The money from your sale cannot touch your bank account. It has to go to a qualified intermediary, basically a third party that holds the funds and ensures compliance. Here's something else. You can exchange into more than one property. You're allowed up to 3 properties during the 45-day identification period. Want to sell one apartment building and buy 3 smaller ones? You can do that. Part 2. The real wealth building advantage. Let me show you why this matters over time. Scenario 1. You buy a rental property for $300,000. It appreciates to $500,000 over 5 years. You sell it, pay $40,000 in capital gains tax, and you have $460,000 to reinvest. Scenario 2. Same property, same sale price, but you do a 1031 exchange. You have the full $500,000 to deploy into your next investment. That extra $40,000 is compounding for you. In year 1, it's generating rental income. In year 2, it's appreciating with the market. Over 20 years, that $40,000 could become $80,000 or more depending on your market and property management. Now multiply this across multiple exchanges. Investor A does 2 1031 exchanges over 10 years. They defer roughly $80,000 in taxes. Investor B sells their properties traditionally both times. Investor A has $80,000 more principal working for them. That's why wealthy real estate investors love this. They're not trying to be clever about taxes. They're trying to keep more capital in the game. Reinvested. appreciating, producing income. It's legal. It's structured. It works. Part 3. What you need to know before you use this. First, hire a professional. This isn't something to DIY. A qualified intermediary costs a few $100s. A mistake costs you tens of thousands. Worth it. Second, understand state taxes. California and New York have aggressive tax policies. Your state might not offer the same deferral benefits. Know your situation. Third, this only works if you're reinvesting. If you want to cash out and go to your Roth IRA or Fidelity brokerage account, a 1031 exchange doesn't help you. The replacement property must be real estate held for investment or business. Fourth, keep documentation. Keep every receipt, every communication, every deadline proof. The IRS will ask. And finally, this is critical. 1031 exchanges are best used when you have a clear strategy. Are you scaling your portfolio? Moving to a better market? Consolidating multiple properties into one? Use the exchange strategically, not randomly. If you own rental properties or investment real estate, a 1031 exchange should be on your radar. It's one of the few remaining tax advantages the government allows for real estate investors. And leaving it on the table costs you money. That said, always talk to a CPA or tax professional before executing. Everyone's situation is different. If this made sense to you, if you're building wealth through real estate or you're just starting to think about